everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video. This is a video series we started a few months ago whereby I select a recent Undervalued Dividend Growth Stock of the Week article and the associated stock that was written about in that article, and then we do a video on that article highlighting the article, talking about the numbers, and kind of going over everything in real time. So showing where the numbers came from, where the conclusion came from, where the valuation came from, putting it all together in a video, so that way it keeps me honest and it shows you readers as well as you follow along kind of what we're talking about with these articles, why these articles are valuable, why they should be read, how they can serve you, how they can provide value for your life, how they can help improve your wealth and income and everything. Because when I write these articles, I'm not just coming up with these ideas off the top of my head. I actually use everything I'm talking about in my own life. I kind of practice what I preach. I don't just talk the talk, I walk the walk. And so everything I'm writing about in these articles with saving and investing in these high quality dividend growth stocks, I'm doing, and I've been doing for going on more than almost 8 years now. So, and it's radically changed my life. So as we've talked about in prior videos, of course, we're a few videos in the series. We go over again one of the more recent Undervalued Dividend Growth Stock of the Week articles, and you can find the whole archive there if you're at dailytradealert.com. You go under Dividend Growth Investing heading there, you click on the tab for Undervalued Dividend Growth Stock of the Week, and it'll pull up the whole archive, which stretches back to late 2014, October of 2014. So we're almost in October of 2017, so it's been going on 3 years, and it's been great. I've had a lot of fun doing these articles. I really enjoy writing one each week. I enjoy presenting these compelling long-term investment ideas to you readers, to the investment community at large, and it's a great honor of mine. I'm super humbled by it, and I hope that we're able to continue doing it for a while, both the articles and the video series, if you guys are enjoying it. So the article I selected for this week's video is Lowe's companies right here. And if you click on that link there for Lowe's, it'll take you to the article, which I've already done. I've already clicked on it. I've already got all my stuff pulled up here so we can do the video, so that I don't waste your guys' time clicking on things and popping things up. I've already got everything loaded and ready to go. With the article that I wrote on Lowe's, of course, every article starts out with kind of a big idea in terms of what I was just talking about a moment ago, why you should be interested in this stuff, why you should be reading this article, what's so compelling about what we're talking about, how this investment strategy and how saving and everything else can radically change your life. What's kind of the buy-in, what's in it for you. And I talk a little bit about that using, of course, my own experience as a platform for that, but also just kind of talking about ideas from a very high level. So when I wrote about Lowe's, of course, again, every article starts out with a couple ideas up at the top. I kind of presented a quandary or a question: is the stock market, is the stock market's gift also its curse? And what I mean by that is, I think a lot of people, well, I don't think, actually, when I first started investing and I started telling people that, hey, I'm going to start buying stocks, I'm going to start saving, I'm going to start putting my excess capital into some of these really good businesses out there that pay increasing dividends and stuff. Most people, well, pretty much everybody, I should say, was they thought I was kind of like I was gambling my money, or I was going to waste my money, and I didn't know what I was doing, and all my money was going to go to zero, and they thought it was kind of crazy. And not only that, but they also kind of seemed almost aloof to it. It seemed like they had this attitude that the stock market is somehow this secret thing that only really rich people or the elite, the 1% or something has access to, and only they know how it really works, and it's this puzzle or something, this enigma, and it's not like that at all. I think that people assume because the stock market has produced so much wealth for so many people over a very long period of time, that it's somehow like, oh well, I can't possibly be involved in that. There's no way it could work for me. It's worked amazingly for those people, those other people out there, but not me. And of course, you don't become those other people unless you make the steps, unless you travel down that road. I'm now one of those people. I think that when I was back working for a living and I was broke and I was just like them, we'll say, they thought, wow, that's all for these, for the 1% and the elite and stuff like that, and there's no way it could work for us. Well, I was that person, and now I'm over in this other category. I kind of moved from the working class to the investor class, and it isn't that hard. It doesn't take that long. And so, I think there's this mindset to where the stock market is such an amazing platform for building wealth and income. It's extremely powerful. It's one of the best platforms that's ever existed to do that. Because of that, I think it also makes people think that, I think it intimidates people, and it kind of keeps them on the sidelines. So I talked a little bit about that in the article about why you shouldn't let fear hold you back, and you shouldn't be intimidated by the stock market, and that's what we talk about these articles. I've been, again, writing them since 2014. I've been writing about investing since early 2011. So, we're going on 7 years for that. And I've just been talking about it, like, hey, I'm just a regular guy, I'm just an ordinary guy, but I'm going to use this platform to, buy myself financial freedom, to gain financial independence, and that's exactly what I did. I have links to my real life 6-figure stock portfolio, the dividend growth stock portfolio that I own, that I've built with real life middle class money at a regular day job, just by living frugally and investing that savings routinely in these high quality dividend growth stocks. So I talked a little bit about that, about why we should be interested in this, how this can change your life and everything like that. And then of course we get into why it's important not just to invest in dividend growth stocks, but you don't want to go on and I always include a link to David Fish's Dividend Champions, Contenders, and Challengers list, which you have a link to right here, and that list contains information on more than 800 US listed dividend growth stocks. But while it's a great investment strategy, while dividend growth investing is incredibly powerful, it's important not to just go on David Fish's list and just pick a random stock at a random price and just buy it. That's not quite how it works. So you first want to make sure you're investing in businesses that are within your circle of competence. You then want to make sure that there are durable competitive advantages, strong fundamentals. You want to see growing profit, growing revenue, a solid balance sheet that isn't too highly leveraged, good profitability, things like that. And you also want to see the dividend metrics. You want to see strong dividend metrics. Just because a stock is a dividend growth stock, if it's growing its dividend at, just 0.5% a year, well, inflation is expanding at a higher rate than that. So eventually your purchasing power is actually going to be reduced over time. You want to actually invest in companies that are growing faster than inflation, giving you dividend increases that at a higher rate than inflation, increasing your purchasing power, which expands your opportunities down the road, either through lifestyle inflation or just additional opportunities, additional flexibility. For me personally, one of the things that I'm super interested in is philanthropy, and that's going to continue to grow as my dividends continue to grow and outpace inflation. So as my purchasing power increases, one of the things I like to spend my money on is trying to help others and that are less fortunate than myself. But what you do with your money down the road is totally up to you. But the key is that you want to make sure that you're investing in good businesses. Just because a stock is a dividend growth stock, just because it's been increasing its dividend for say 6 or 7 or 8 years, it doesn't necessarily automatically make it a great business for you specifically. It should be a business that you understand, a business that you can get behind, a company that you've actually gone through and analyzed and you looked at, and perhaps most importantly, which is what today's article is all about, is the valuation. You want to make sure you're not paying too much for shares in a business, even a good business. If you significantly overpay for stock in a company, even a good business will have a hard time catching up to that valuation over time. And in the meantime, that can cause severe lags in terms of the growth of your wealth and income and everything else. And when you're looking at valuation in terms of dividend growth stocks, especially in terms of the yield, the valuation affects the yield. Generally speaking, all else equal, a lower price, assuming the prices drop below value, a lower price will result in a higher yield. So that affects not only the current income you're going to get when you buy that stock, the income you're going to start collecting almost right away, but it affects your long-term aggregate dividend income throughout the course of that investment, throughout the lifetime of that investment. So you got to be thinking not just about today's yield, today's dividend, today's income, but the yield, the dividend income, the aggregate income over the course of the lifetime of the investment. And for me, you know, as Warren Buffett has said, you know, my favorite holding period is forever. I mean, I don't necessarily hold every single stock forever. Most of the stocks in my portfolio I've never sold. I've held since I bought them. But occasionally, you know, business, you know, requires reducing or selling or something like that due to any number of factors. But if you are planning on holding forever, which again, long-term investing, it's, you know, generally you want to think about, you know, investing for at least the next 10 or 20 years of your life. You know, the amount of income you're going to collect can be significantly affected by the valuation of the stock when you buy it. So you want to, you know, make sure you're aware of that and make sure that you understand what, you know, because the price of a stock doesn't necessarily reflect the value. The value gives context to price. Without knowing value, it's impossible to know whether or not price is appropriate. You know, and I like to use an analogy. If I hold two objects in my hands and I tell you the object in my left hand is $10 and the object in my right hand is $100, which is the better deal? Well, you can't just say the $10 object because you don't know what it's worth. If the $10 object is worth $1 and the $100 object is worth $1,000, then the $100 object is obviously the much better deal. So without knowing value, you know, it's impossible to tell whether price is a good deal or not. So you always have to be aware of value first, then get into price. And depending on where value is at, you'll know whether or not the price is appropriate. So we talked a little bit about that, about how valuation affects your investment over the long haul, about how undervaluation presents a number of benefits to the long-term investor, confers a number of benefits to you, which specifically is higher yield, which I just talked about, greater potential long-term total return, which of course is affected by that higher yield, as well as the upside that potentially exists between the lower price and the higher value, and then less risk by introducing a margin of safety when you invest. So we talked a little bit about that throughout here. And then I linked to Dave Van Knapp. He's a fellow contributor on Daily Trade Alert, longtime dividend growth investor, as well as myself. And he wrote a lengthy series on dividend growth investing, which he calls his Dividend Growth Investing Lessons. And one of them is, one of those lessons, like a chapter in a book almost, is on valuation. And I linked to that right there, which is a great read. So today we're talking about Lowe's. And I selected this stock for a number of different reasons, but as we'll show in the article as we go along, the dividend metrics, especially the dividend growth track record, is phenomenal for Lowe's. And you know, when getting into retailers, of course, Lowe's is a retailer, as we'll talk about. You have to be kind of careful with, you know, looking at those legacy retailers that have maybe had a really good track record over a couple decades or a few decades, but are maybe facing a number of substantial headwinds in terms of how the business is going to work going forward. You know, they're obviously e-commerce is impacting the business model of traditional B&M retail, so you want to be careful with retail. But I think Lowe's is a pretty compelling long-term idea right now, based not only on the quality of the business but also the valuation. So we've got Lowe's here. It's one of the largest home improvement retailers in the world. Obviously, a direct competitor would be Home Depot. So they're kind of number one and number two here in the United States. And I mean, they're huge retailers, if not just in the United States, but across the entire world. They operate more than 2,300 home improvement stores and hardware stores across U.S., Canada, and Mexico. So each the average store size is approximately 112,000 square feet, and they offer about 36 or 37,000 items in stock on average in each store, which is huge. And kind of talking about my prior point, when you're investing in retail, and you know, you got to be careful with, you know, investing in retailers that maybe are facing some big challenges, and they're maybe not turning that corner as well as they should. When looking at, you know, okay, well, obviously the future in retail is definitely skewed more toward people buying stuff online and just staying at home and waiting for it to come in, and, you know, come in through UPS or FedEx or whatever, come in their door. Retailers have to be kind of aware of that, and on top of that, and certainly creating a very large shift in terms of how they view their business and how they do business. And with Lowe's, I think what's great about them is that, you know, and I talk a little bit about this when I talk about a lot of legacy retailers facing massive headwinds from e-commerce. Lowe's doesn't sell clothes or small trinkets. I mean, it's not like a general merchandise retailer where they're selling, you know, yeah, maybe a pair of shoes, or you're looking at maybe a throw pillow for your couch or something, you know, or you need something for your kitchen, some, you know, maybe some silverware or something like that. It's not something where you can just, oh, well, I'll order it and wait for it to come in or whatever. Lowe's sells a lot of more immediate items. I mean, these are home improvement items that, number one, often are more immediate. I mean, if there's something that breaks in your house or something that you need to fix something, you're going to probably need it pretty quickly, and you're not going to wait a day or two or three to go get it. You're probably going to want to go to Lowe's right then and there to get it. A good example, actually, I live in Florida. I'm going to be moving in a couple weeks, but I live in Florida for right now, as I've been living for many years. And we just went through Hurricane Irma, of course, and people were lined up around the block at stores like Lowe's and Home Depot trying to get generators and wood to insulate their homes from wind. You know, they were blocking off their windows if they didn't have hurricane shutters. So they were going in there and getting plywood. They were going in and getting chainsaws and you know, handheld drills and saws and water and all kinds of stuff. So it wasn't like they were like, well, I'm going to go to Amazon. You know, it's hurricanes rolling in, but I'm going to go to Amazon and, you know, order this and that and this. No, they were at Lowe's going and getting stuff right now because they need it now. So I think Lowe's is a little bit insulated in terms of the immediacy of a lot of the items that they sell, number one. And number two, a good chunk of their consumer base, which if you're on their investor relations site, which is right here, which I've already pulled it up for the annual reports, of course, which we're going to go over. But they have a nice little fact sheet here on the right-hand side, which I pulled up as well. And they talk a little bit about how their consumers break down, and they've got pro customers that break down to about 30% of their sales. And these are clients that maybe have, you know, rental homes or their MRO, which is maintenance, repair, and operations. So these are people who are professional that use these items that Lowe's sells in a professional capacity. And you know, those also are clients where it's a little bit more difficult to just order something online and wait for it. A lot of times you need something, you need it right now. So that's kind of a key aspect of the business. In addition to that, they also offer the do it for me, the DIFM aspect of their business, where you go into Lowe's and you say you want to you know, you bought your house and your house is getting old, you want to redo your bathroom. You know, let's say your wife is saying, honey, I need a new bathroom, and you know, she's not asking, she's telling, let's say. You know, you're going to Lowe's and you're getting that new vanity, you're getting this, you're getting that, and what you're doing is, a lot of times, unless you're extremely capable of doing it yourself, you're signing up for the DIFM service, which Lowe's, you know, has contractors and things like that, where they actually arrange the whole project to be done in your home. And again, that's not something where you're going to be, at least not right now. That could change down the road, but that's also another good example of something you're really not going to be doing online. You're going to be going there, you're going to be looking at the vanities, you want to measure things out, you want to look at things, you want to talk to somebody, you want to arrange a project. And these are things that, again, as of right now, unless something changes pretty dramatically down the road, these are things where, again, there's that immediacy in terms of the items that you're trying to go in and buy, and there's also that aspect where you need some professional assistance a lot of times. In addition to just the sales staff that they have at these companies, they're trained pretty well. I don't even do home repairs. Very rarely do I need to go into a Lowe's. I rent. I love renting. I've talked about this before in my writing. I don't ever really want to own a home. I very much prefer renting, but even me, I've had to go in occasionally and go get a few things. And the few times that I have had to go in, there's actually a Lowe's right down the street from me. The few times that I've had to go in there, you know, I've stopped somebody and asked, you know, I think I might need this or that, and they're like, boom, you know, this aisle right here, you got to look at these sizes, and they're on it. So that's something, again, that not only did I not go online to go get it because I'm like, you know, I don't really I'm not sure what I need. I went in there, I asked, I got some professional help, and so that's something that I don't know if you can put a price tag on it, but I certainly believe that it insulates the brand and the business model. And I talk a little bit about that in here as well, about how you need to specialize immediate items and a lot of other items that you're not going to be, you know, I used the countertop as an example. You're not probably going to be ordering a countertop online. You're going to go in, you're going to look at your countertop. You want to, you know, let's say you want granite or something and you want to see a specific strain of granite. You're going to be doing that in person. So, you know, again, it's not just a t-shirt or something like that. So it's just something to keep in mind. And these are also a lot of times big items that, you know, it's not easy or cheap to ship a lot of this stuff. So it's just a different, it's a business model that I think is really strongly insulated from the headwinds of e-commerce. But on top of that said, Lowe's does have their e-commerce sales already built in. They've already got the e-commerce business built up. They've got the websites and things like that. So if there are things where, you know, you can, you know, well, I need this and I need that, but I can wait on it a couple of days, you're going to maybe order that online. And obviously Lowe's has to compete heavily on price there, which is going to impact margins. And that's, as I talked about before with some of these other legacy retailers, I think there's this fear maybe that a lot of these retailers are just like going to go out of business magically overnight or something due to e-commerce. I really don't see it happening. I think what is happening and what's going to continue to happen is that a lot of these legacy retailers are going to be facing challenges in terms of their margins. They're going to be facing margin compression because they're competing so heavily on price. You know, if 20 years ago, you know, all your choice was to go down to the hardware store, Lowe's, or maybe your local hardware store and buy your items, you didn't really have that much of a choice. Whereas now you can go online and kind of, you know, do your thing. You can even do it in the store from your smartphone. You say, well, you know, I like this drill, but let me see what else is out there. So there's definitely some heavy competition on price, which does impact margins. But in terms of some of these companies going out of business, especially like a Lowe's with all the other areas of insulation that are going on, the barriers to entry and things like that, I think that the odds of some, you know, massive change in the business model happening anytime soon, it just seems unlikely to me. But so I talked a little bit about Lowe's, what they do, how they make money and things like that, and then we get into the dividend metrics. And again, as I alluded to a little bit earlier, the dividend metrics with Lowe's, just fantastic. You know, I know that they compete with Home Depot, but Home Depot isn't even close to Lowe's in terms of the dividend growth track record, in terms of dividend metrics. Not even close. Lowe's has not only one of the best dividend growth track records in retail, but in the world. There are very few businesses anywhere in any kind of industry that have the track record that Lowe's has. And getting into that, the company's paid an increasing dividend for 55 consecutive years. And in order to find that, I think I did forget to pull up one link, didn't I, guys? I gotta pull up David Fish's list right here. I talked about it and I have the link there and I didn't even pull it up myself, but let me pull it up here and I want to show you where I got these dividend metrics from, which I always use David Fish's Dividend Champions, Contenders, and Challengers list, of course, for all the metrics which he compiles for the investment community. It's a fantastic resource. I hope David Fish is immortal and he continues to run this list for another 100 years, because it's just an incredible resource. You know, you're not going to find anything else like this anywhere else online, guys. So it's just great. You should be really pulling it up routinely and kind of referring to it if you're into dividend growth investing. It's, yeah, I kind of call it one of my favorite reads, even though it's just numbers and even though it's stocks that I already know about and I've looked at many times. I just like looking through it and like, wow, look at that company, wow, look at those dividend metrics, wow, look at that. I don't know, I like referring to it pretty consistently, which I do, of course, as part of my writing, but also just in my private life when I'm looking at investments. So we got Lowe's pulled up right here. So you see the 55 consecutive years of dividend increases right there. Just phenomenal. Again, there are very few companies in the world that have that kind of track record that they can lay claim to. So pretty incredible. And let's see, I gotta scroll back down to the dividend metrics here. So we've got the 55 consecutive years, and again, as I note that in the article, I try to put that in perspective for you guys. That time frame spans multiple wars, stock market crashes, economic and political cycles, and even the recent financial crisis. And even through all of that, Lowe's just kept handing out a bigger dividend to their shareholders every single year. Pretty incredible. And when you're thinking about investing in these companies and you're thinking about, you know, I want a company that I can be pretty sure that my dividend is going to continue flowing and growing, as I like to call it, Lowe's is pretty tough to beat in terms of that. So they've got that really incredible streak of dividend growth, which is already pretty amazing. But then on top of it, they've got a 10-year dividend growth rate of 22.9%, which I want to point out something here real quick, guys. A lot of people, when I do my dividend, when I do the dividend discount model analysis and I model out, say, 6% dividend growth or 7% dividend growth for the very long term. I've talked about this in prior videos. I'm really not doing it, you know, even though the number is infinite, it really carries out to infinity. After a certain time period, which I don't know if it's a few decades out or however long it goes out, not that far, but it becomes kind of a rounding error after a certain time period. But in addition to that, I'm really only thinking about how long I'm going to be alive. And a lot of these companies can continue growing their dividends at 6, 7, 8% for many decades. And we can see here, Lowe's has been increasing their dividend for 55 consecutive years. So if we go back 10 years, they had grown their dividend for 45 years. Yet they continued to grow their dividend over the next 10 years from that time period, if we go back 10 years, at an annual rate of 22.9%. So if somebody would have done a dividend discount model analysis 10 years ago and said, well, I think Lowe's will grow their dividend at over 20% for the next 10 years. Somebody else might have said, well, they've been growing it already for 45 years. You can't just indefinitely grow your dividend at these huge double-digit rates. Well, you can. And, Johnson & Johnson's another good example. They've been growing their dividend for, more than 5 straight decades as well. And they continue to pump out 6, 7, 8% dividend increases year after year. So you can do that for a very long time period. Can you do it for infinity, for forever? No. But, because at some point you become bigger than the entire economy, right? So you can't do that forever, but you can do it for a very long period of time. And in the context of the dividend discount model analysis, that's all that really matters to me. Because not only am I not worried about infinity, but I'm not going to live forever. So I'm just worried about what can these companies do for the next maybe 30, 40 years, as long as I need that money to continue to flow and grow. So again, if you're looking at a stock where you want to have some assurance that that dividend is going to continue to come in, that it's going to continue to increase, that's going to continue to support your financial independence or your lifestyle or your income or whatever you need it for, pretty tough to beat Lowe's here right now. And one thing I like to look at whenever we do that dividend growth rate is I like to look at maybe acceleration or deceleration. And you can see here, check this out, guys. Look at how consistent this is. So you've got your 10-year dividend growth rate at 22.9%. You've got your 5-year at 20.3. You got your 3-year at 22.8, and you got your 1-year at 23.5. The most recent dividend increase was not quite up to those lofty levels, but still nonetheless very impressive. But wow, is that really consistent there? So it wasn't like the 10-year dividend growth rate has been, the average was impacted by maybe a one-off humongous year or something where they had a massive dividend increase and the rest of the year sucked. It isn't like that at all. It's just been, Lowe's has just been incredibly consistent. They've grown their dividend for 55 consecutive years and just 22%, 20%, 20%, 20% year after year after year. I mean, that is amazing stuff. So I just wanted to kind of point that out, because sometimes when you see a big dividend growth rate like that over 10 years, you'll see a massive deceleration because they had maybe expanded their payout ratio from a very low level, and you'll see this a lot of times with companies with shorter dividend streaks. Like, let's say they have a dividend growth streak of 15 years. Well, 15 years ago they had a payout ratio of 0. So for 10 of that 15 years, they were just expanding that payout ratio dramatically, right? And you'll see a deceleration. You'll see like 20 here, and you'll see like, maybe 15, and you'll see maybe like 8 or 9 or something, and it'll kind of, further, so on and so forth. But with Lowe's, you don't see it at all. It's just a straight, steady 20% plus dividend growth rate right through the decade. Really incredible stuff. And then on top of that, of course, we talk about the yield a little bit. I've got the fairly appealing yield, 2.2% right here. I'm gonna pull that up. Google Finance has to reload for me here. So we've got here the yield is 2.1% now. So obviously that means since I wrote that article, the stock has gone up, because all else equal, price and yield are inversely correlated. So if the yield is lower, then the price must be higher. And we'll see at the bottom, because I think there's a kind of a price tag at the bottom of the article. But so yeah, the yield when I wrote the article, 2.22%. It's not coming in at 2.1, so it's a little less appealing than it was when I wrote it, but still very solid yield when you're looking at over 55 years of dividend increases. You're looking at a 10-year dividend growth rate as well as a short-term dividend growth rate well into the double digits here. You're getting that yield, which is kind of right in line with the broader market, but you're getting dividend growth well in excess of the broader market. You're getting a dividend growth track record that's well in excess of the broader market in terms of the average stock in the S&P 500. So that's really good stuff right there. And I want to talk a little bit about when I earlier in the article, when I talk about those benefits that undervaluation confers the investor, typically it's a higher yield because you're getting that lower price below fair value, which implies that the yield would then be higher as a result, right? So when we look at that, we go over to this valuation tab on Morningstar. I want to just kind of show you guys something here real quick. The 5-year average yield on Lowe's stock is 1.5%. Yet right now it's 2.1. When I wrote the article, it was even higher. So there's definitely a gap between what the average yield that investors were willing to accept over the last 5 years compared to what they're willing to accept now. And generally, when you see, when you see a kind of a fairly long-term average in yield, and you say, well, this stock typically yields around 2% or something like that over a fairly long period of time, and all of a sudden it's yielding 3 or 4, that would generally mean that the price, something happened to the price. The price dropped somewhat precipitously that affected that yield, which made it rise as a result. And that's what happened here. So if we look at the chart for Lowe's, you can see here. So what's happened is, it didn't really drop so much as what happened was Lowe's continued to just increase that dividend, just pump it out here. You see how consistent it was. You see 41 cents here, 35, 28, 23, 8. So they've just been increasing it pretty dramatically, and yet the stock had that massive run here, but then just kind of stopped. Right about early 2015. It's just been straight through. So the price didn't really drop so much as the dividend just continued to pump out these huge dividend increases while the price didn't really go anywhere. So if you were buying the stock in say early 2015, you were paying what, 75 bucks a share, something like that, in that range, 75, 23 right there, and you were getting a quarterly dividend 23 cents, right? Now you're getting a quarterly dividend of 41 cents, and you're paying almost the same price, as what it was a couple of years ago. And yet the business continues to pump out higher revenue, higher profit, and everything else. So, that's certainly possible the stock was overvalued back in early 2015, and the market is just correcting a previously incorrect valuation. That's certainly possible. But on the other hand, it could be that, hey, that wasn't a bad price to pay back then. It's just now that the stock hasn't really gone anywhere while the business has really improved, and that's caused the valuation obviously to increase while the price hasn't gone anywhere. If you have a price and value pretty fair right here, but the value continues to move up and up and up and up while the price doesn't really move, then obviously that creates undervaluation, creates the higher yield, and everything else that we're talking about. Okay, so that's kind of what's happened here. And I also point out that a long-term dividend growth rate of 20% plus and yield of 2% plus, that paints a pretty nice picture in terms of total return. And even with the stock that hasn't gone anywhere in a couple of years, if you look out over the last 5 years, you can see here the stock's up 165%. So even with the stock really going nowhere for 2 of those 5 years, it's still been an incredible investment. If you would have bought the stock 5 years ago, it's just been an incredible investment. And kind of like how that valuation was setting you up pretty nicely at 31 a share or so 5 years ago, I think you're getting set up pretty nicely here below 80 a share moving forward, because because the business is so much better than it was 5 years ago. The price, of course, is a lot higher as well, but it's not any higher than it was 2 years ago, and certainly it's better than it was 2 years ago. So if you're looking at more of a shorter term picture there, it definitely looks like some opportunities presented itself. And then obviously when we look at the dividend metrics, the last thing I look at I look at the 4 numbers. I look at how long it's been growing its dividend, the 10-year dividend growth rate if it's been growing its dividend for 10 years, the current yield, and then the payout ratio, which of course tells us what percentage the company is paying out in terms of its dividend against its earnings per share. So as I've talked about in prior videos, I generally look at a 50% payout ratio as the perfect harmony or balance between retaining earnings for the company to continue growing either through M&A or maybe even to pay down debt, to fund internal growth and things like that. Like with Lowe's, for instance, they have to fund all these store openings and things like that as they expand their footprint, and they have to build everything out, stock these stores, even as they grow their online presence. That takes a lot of money to continue doing that. So you want to have some flexibility, you want to have some retained earnings there in the company, but as a shareholder, I also expect my fair share of the profit. And so when you look at that and you say, okay, well, on one hand, we want to continue growing the business, we want to be able to fund things and things like that. We also want to make sure the shareholders are happy, because the shareholders are the collective owners of any publicly traded company, so they deserve their fair share of profit. What's the right split? And I say it's just 50-50. I say that's the perfect balance there. You're saying, okay, company, you're getting half to continue growing and doing whatever you need to do with that money, and then we want our half of the money as well. And Lowe's is basically right there. We're looking at almost a 50% payout ratio, which is very nice. And where you get that number, if you look at trailing 12 months earnings here at $3.55, $3.55, you get your quarterly dividend 41 cents, so it's $1.64 annualized. And you look at trailing 12 months earnings at $3.55. So something's probably changed since I wrote this article. Again, let's see, this article was published on September 3rd. That means I wrote it at the end of August, so I'd have to look back at what's happened in the interim. I wonder if they, let's see here. Let me go to their investor relations site here real quick, guys. August 23rd was Q2 earnings. I wonder if that wasn't reflected when I started writing the article. It was published on the 3rd. I would have been writing it right in here, so yeah, I'm not sure why that changed a little bit. I've got the payout ratio closer to 51%, and looking at it now, it comes in at closer to, it's still pretty close to 50%, so I wonder if maybe the numbers weren't quite reflected yet when Q2 came out, but nonetheless, you're still looking at a pretty close to a 50% payout ratio, and if we look back, one nice thing I like to look at when looking at the payout ratio is kind of whether it's been expanding or contracting, and we see the payout ratio here. You do see with Lowe's, although that dividend growth rate hasn't decelerated, it's been consistent as we talked about, there has been a massive expansion in the payout ratio. You see here it was 15.6% 10 years ago, and now we're getting pretty close to that 50% mark as we just saw. So Lowe's has obviously been growing its dividend much faster than earnings, which tells us that while they have been very consistent with that high double-digit dividend growth annually over the last decade, you know, it's probably not going to continue like that moving forward simply because the business isn't growing that fast. And moreover, the business is even bigger than it was 10 years ago, which of course law of large numbers tells us that, you know, as the business gets bigger and bigger and bigger, it becomes harder to maintain that kind of growth rate. You know, they were doing $48 billion worth of sales 10 years ago. They're now doing over $65 billion. It's a pretty large company. $65 billion in revenue per year is pretty massive. So, you know, for them to continue growing that dividend double digits, first of all, isn't really possible based on the trajectory of the business as it's been over the last 10 years, because the payout ratio would eventually, well, dividends would eventually exceed earnings, maybe within a decade or so, but also because the growth rate might slow down a tick even a little bit. So just something to keep in mind. There's kind of a dynamic going on there where, as I talk a little bit about in the article, and as I model out the valuation, you know, I would not expect 20% plus dividend growth to continue much longer. You know, maybe even over the next couple of years, you would probably see that fall quite a bit. I say right here, I say, as such, I wouldn't expect the dividend to continue growing at 20% over the near term. However, the company does have the capability to continue growing the dividend at a comfortable level, as I'll discuss below. And I kind of, what I mean by that, at a comfortable level, I mean at an appealing level, an attractive level. I mean well above the rate of inflation. It's not like Lowe's isn't going to continue growing the dividend in the high single digits. I think they can continue doing that, which certainly is well above inflation, certainly is going to increase your purchasing power, and certainly provide for it sets up for a very nice picture in terms of total return going forward too. So definitely still a lot to like. I'm just saying that, you know, for them to continue growing that dividend at 20% when the business isn't growing that fast and when the payout ratio is much higher than it was 10 years ago, it just they're not in that kind of position they were 10 years ago. 10 years ago they were in a great position and just continued growing that dividend at a very high clip. You know, I wouldn't expect that to continue like that indefinitely, and certainly maybe not even over the near term. But you know, could they hand out a dividend increase of say 10-12% with the next dividend increase? Absolutely. Could it maybe even be a little higher? Sure, it could. It really depends on, you know, where the business is growing, you know, what the underlying growth rate is for profit and cash flow, and where they want to keep that payout ratio at. But I think they're in a pretty comfortable level there. I don't know if they'd want to really expand their payout ratio too much more beyond where it's already at. I think it's a very comfortable level, certainly not anything I'd be concerned about. Likewise, it also doesn't allow for a ton of expansion, so it's in a good range right now. So if the business is growing in the high single digits, then the dividend should continue growing at least that rate as well, which is what we get into next. Of course, in order to value the business, I like to look at, okay, what has the business been doing over the long haul? And I use 10 years as a proxy for the long haul. So what's the top line and bottom line been doing over the last 10 years? And then, you know, what do I think it's going to do going forward? Because, of course, we don't invest in where business has been. We invest in where business is going. So we need to kind of extrapolate out that future growth based on where they've already been. And in order to do that, I look at top line and bottom line growth over the last 10 years. And then I kind of compare that or combine that with a near-term forecast for profit growth, and I use the CFRA, which is a professional analysis firm. They kind of extrapolate out. They forecast what they think a business will do over the next 3 years in terms of compound annual growth in a company's earnings per share. So they're kind of saying, well, we think the business is going to be kind of somewhere in this range over the next few years. And I usually take that number and kind of, you know, put my own spin on it and say, well, is that aggressive? Is that conservative? Where do I think that is, you know, relative to where they've been and what I think their opportunities are moving forward? And then I take those two numbers and I kind of blend them together and come up with a conclusion based on that. So looking at that, of course, we need to pull up the financial reports. I've already got the 2 annual reports pulled up here. That's the fact sheet. So I've got the 2007 annual report, and I've got the 2016 annual report, which shows us, for both associated fiscal years, their numbers. So when we look at the long-term top line and bottom line growth rate, of course, we're looking at the top line first. We're looking at net sales or revenue. So for the fiscal year ended February 1st, 2008, they had $48.283 billion in sales. And so we pull up a compound annual growth rate calculator, as I've talked about in prior videos. I use Investopedia's, but you can use whichever one you'd like. So we've got that number, 48,283. And then we've got the most recent number, which is 65,017, so a little over 65 billion, right? And then we're using 9 compounding periods because the first period isn't a growth period, it's the starting point. So we've got 3.36% compound annual growth rate for revenue, which I reflect right here. So you see the 48,283, you see the 65,017, fiscal years 2007 to 2016. Of course, the fiscal year and the calendar year don't match up perfectly with a lot of companies, as we can see here with Lowe's. But we've got a compound annual growth rate of 3.36%. And I note that that's just a little disappointing. Not big. I'm not real concerned about it, but I usually like to see mid-single digit top line growth from mature companies. And Lowe's is obviously a mature company with well over 60 billion in sales a year. I'd prefer to see something 4, 5, maybe even 6%. But again, with them doing as much business as they are doing, and especially considering the last 10 years we had that financial crisis in there, which there was that massive burst in the housing market, which certainly affected companies like Lowe's. I give them a little bit of leeway on this. This was, as I've talked about in prior videos, when I'm doing these videos in 2016 and 2017, I'm doing these articles in 2016, 2017, and I'm looking back at the prior 10 years, which includes years like 2007, 2008, 2009. That's a very challenging 10-year period to look back on. So when I'm doing these numbers and when I'm doing these dividend discount model analysis valuations and things, and I'm using the last 10 years as my proxy for the long haul, that's a pretty challenging 10-year period. So I think I'm erring. I think we're erring on the side of caution here when we look back at the last 10 years for a lot of businesses, because a lot of companies, even really stable businesses that are in great shape like Lowe's, were impacted by the financial crisis and the Great Recession. It was almost impossible not to be impacted in some way. I mean, I do like to see secular growth from the businesses I invest in, but you got to be aware that there's going to be some bumps along the way, even with the best companies. And the last 10 years provided for some of the biggest bumps that you're ever going to see in your lifetime. That was almost a once-in-a-lifetime type of financial event that impacted us, and a major impetus for that was the housing market, which of course is related to Lowe's. So when I see that 3.36%, my first thought is, I'd like to see maybe 4, 5, 6. But then I think back and I'm like, well, this 10-year period that we're looking back on was extremely challenging for a company like Lowe's. So keeping that in mind, that's really not too bad. Of course. Also, that all said, I place a lot more importance on the bottom line. The revenue is great, but if a company's growing revenue year after year, year after year in big numbers, but can't deliver a profit from that, then it doesn't really matter a lot. If I'm selling $100 worth of goods, but it costs me $120 to do that, then eventually I'm going to go bankrupt, right? I mean, I can say I can sell $50 billion worth of goods, but if it costs me $75 billion to do it, then I'm on fast track for bankruptcy. So revenue's good, but you're really looking at sales and especially diluted earnings per share, which is net income per share on a diluted basis. So looking at that, we've got 186 and 347 as we'll pull up here. We've got diluted earnings per share here, back 2007 in your report for the fiscal year ended February 1st, 2008. We've got diluted earnings per share of 186. We've got, sorry about that, guys. I had to pause it real quick, catch some barking dogs. I got a couple Chihuahuas in the house, and they love to let us know that they're there. So again, we've got 186 for diluted earnings per share for the fiscal year ended February 1st, 2008. And the 2016 annual report, we've got diluted earnings per share of 347, which you see right here, 186, 347. So we're going to look at what that growth rate is. We've got a compound annual growth rate of 7.17%, right? 7.17%. So that's actually pretty solid. Again, keeping in mind that the last 10 years was, I mean, I use the word challenging at the least. I mean, extremely challenging for a company like Lowe's, because you had that burst in the housing market. Of course, a strong housing market portends good things for a company like Lowe's, and likewise, a housing market in shambles, doesn't bode well for Lowe's, and kind of as a tangent to that, as I spoke about earlier, I'm going to be moving here pretty shortly, and when I started looking at places to live, and kind of as a backstory, the reason why I'm moving is I've been with a significant other for many years, and we've unfortunately finally decided to go our separate ways. So she's going to stay in the apartment we've been sharing for many years, and I'm going to go get my own place. And when I've been looking at the housing market across the United States, we have a severe, well, I don't know if I'd say severe, we have a shortage of supply. The demand is higher than supply right now, and as supply and demand goes, of course, prices are high, and value is hard to come by in the housing market in the United States, and that goes for whether or not you're buying or renting, whatever you're deciding to do. But the housing market's pretty tough out there right now, and as such, I think that Lowe's should continue, Lowe's and companies like it, frankly, should continue to do pretty well looking out over at least the next 10 or 20 years, because we really need some more supply online here in America, across the country. There's a shortage of housing out there for sure, and housing continues to grow much faster than wages as a result, and I think value is really hard to come by. So as some of that supply comes online, of course, that positively impacts a company like Lowe's. So when I look at the 7.17% compounding annual growth rate for Lowe's over the last 10 years, gosh, I think that's probably a low mark for them. I mean, that's probably a pretty low hurdle to clear moving forward, even keeping in mind the law of large numbers, even keeping in mind that they're doing $65 billion worth of sales. Could they accelerate off of that? On one hand, you do have the larger numbers. On one hand, you do have more stores. On one hand, you do have that saturation and things like that. But on the other hand, again, I think you've got a really challenging 10-year period we're looking at, and I think you have a supply and demand mismatch here in the United States, which is affecting prices, and with more people, our country and our world at large is growing bigger, older, and richer. And as there are more people, and as more people have more money, that certainly affects housing. It certainly affects demand for housing, certainly affects the demand for the size of housing. We know that housing has, the average house in the United States is more than doubled since 1950. So there's definitely some long-term trends that are tailwinds for Lowe's, even keeping in mind some headwinds in terms of the legacy retailers and things like that. I think overall they've got a chance that they could maybe accelerate off of this. And speaking to that, as I mentioned earlier, I look at CFRA, and when I look at the prior, I look at when I'm trying to figure out the earnings power of a company, when I'm trying to figure out what the future growth rate for a company might be, because again, in order to value the business, I need to know where they're going, because I'm not investing where they've been. I need to look at, okay, what is their growth rate looking at over the long haul, and then where do I think they're going to go going forward? So again, I use that forward-looking number, that future forecast for earnings per share growth over the next 3 years, and CFRA pegs that at 14%, which, I was speaking about maybe some minor acceleration being possible. They have that doubling over what they've done over the last 10 years. You see here, they have them going from 7 to 14. That's a pretty strong acceleration. I don't know if that, I don't know if I'd count on that, but certainly, if Lowe's comes in and over the next 3 or 4 years, let's just say over the next 3 years, apples to apples, they come in and 3 years from now, in 2020 or 2021 or something, we're looking back and we're saying, Lowe's grew at 11-12%. I don't think that's unreasonable to expect that. 14 would be pretty tough. But I certainly don't think an acceleration off that 7 is unreasonable at all, based on what I was just talking about. And one thing I also wanted to note here, we see there's definitely excess bottom line growth, right, relative to the top line. You see the revenue growing at 3.36%. You see the bottom line basically more than doubling that over the same 10-year period. And generally speaking, when you see excess bottom line growth relative to the top line, when you see profit growth at a much faster rate than revenue growth, you see generally it's due to one of two reasons. You either see some expansion in margin, or you see significant share buybacks, or you see a combination of the two. In terms of Lowe's, really what you see is just a massive reduction in the outstanding share count, as we'll see here. So, and Morningstar has that number. I'd have to go through the I'd have to go through the I'd have to go through the numbers a little bit in Lowe's in terms of their annual report. But Morningstar, as I've talked about before, is usually pretty accurate in terms of third-party data. I would say I'd peg Morningstar's accuracy at 95% plus. In terms of, when you're looking at revenue and earnings per share and cash flow and everything else, they're pretty accurate most of the time. And when you look at their, when I did this article maybe a few weeks ago, I had to go through their actual annual report and find it, but the numbers were accurate, so I'm just going to use this as kind of a shortcut right now for you guys. You've got the outstanding share count right here back in well, fiscal year ended January 2008 for the 2007 annual report for fiscal year 2007. You've got the outstanding share count 1510. So 1.5 billion shares, right? And you've got 881 million shares now. So that's a difference of 629 million shares divided by the starting point, 1510. So you've got a reduction of almost 42%, which I note right here. The outstanding share count is down by approximately 42% over this 10-year stretch. One of the bigger outstanding share count reductions I've come across. I mean, definitely. I mean, for a mature company like Lowe's to basically reduce its outstanding shares by almost half, by almost 50% over just 10 years. So that means there's almost 50% less shares outstanding for shareholders like me or you or anybody else out there, for investors, I should say, because I'm not a shareholder, but for prospective investors to buy into Lowe's. That's a lot less shares floating out there in the world. And like I was talking about with housing just a moment ago, supply and demand, there's a lot less supply of Lowe's shares out there floating around. So of course that not only affects maybe in terms of supply and demand and how that affects Lowe's stock over the long haul, but mainly what we're talking about in context of this conversation is the earnings per share, because the net income is growing along with revenue, but really when you're looking at earnings per share, you're looking at net income per share. So as there are less shares outstanding, of course, that net income is being divided by a smaller number. So although, let's see what net income was real quick so we can just kind of compare. So we got net earnings here at 2.8 billion back in fiscal year 2007, and we've got net income at a little over 3 billion, about 3.1 billion. So actually, guys, net income hasn't grown that much over the last 10 years. You can see here, right? Net earnings 3.1 billion, net earnings 2.8 billion. So net income, net earnings has not really grown that much over the last 10 years. Let's see if Morningstar has that accurately. Net income 2.8 billion, 3 billion. So yeah, you can see here, net income has not grown that much, but because the number of shares outstanding are so much lower, the earnings per share obviously has grown as a result, because there are just less shares to divide that net income by, or net income into. So that's really what happened here for Lowe's. That's the story. So overall underlying growth, not that outstanding, because revenue's only been compounding at a little over 3%, right? So not that great. I mean, again, it's a big company, but as I spoke about a moment ago, I think you really have to give them some leeway on that and give them, the benefit of the doubt, because that 10-year period was so challenging. So overall, not a ton of growth, even though the dividend's been growing at an outstanding rate as we saw here. Well into the double digits, well over 20%, pretty consistently over the last 10 years. The overall growth of the business isn't really that strong. Net income's basically flat, but because they are spending so much money on share buybacks, of course, it reduces the shares outstanding, and so that net income goes a lot further when there are just less, if you're looking at the pie really not expanding that much. If the pie was this big 10 years ago and now it's just a little bigger, well, there are a lot less people eating from the pie, right? A lot less slices of that pie, and that's kind of what happened for Lowe's. So, but I do think there are opportunities for acceleration. Again, going back to that CFRA forecast for 14% over the next 3 years, which I have noted right here. That's a little strong for me. I don't know if I'd really expect that from Lowe's. But again, I think EPS and the growth rate in the range of 8 to 10%. A compounding growth rate 8 to 10% over the next 3 years or so, or even over the near term, medium term, even over maybe the long term. I don't think that's unreasonable to expect, and that would provide for like dividend growth based on where the payout ratio is at, based on where the business is at. So over the next 3 to 5 years, 8 to 10% earnings per share growth, 8 to 10% dividend growth. I don't think that's unreasonable to expect that. Again, it would be a deceleration compared to what dividend growth we've seen over the last 10 years, but we can see here the business hasn't really grown that much, but the dividend has, and again, that's due to that expansion in the payout ratio as we looked at. So getting into the other fundamentals, of course, we look at the balance sheet next. I look at the long-term debt-to-equity ratio and the interest coverage ratio. As I've spoken about many times, the debt-to-equity ratio, it's a bellwether metric for the balance sheet. I don't personally place a lot of importance on it because it can be affected by the equity number, which itself can be affected by a lot of things, including share buybacks, which, as we just saw, Lowe's buys back a lot of stock. That can be included on the balance sheet as treasury stock. That can negatively affect shareholder equity, and of course that can raise the debt-to-equity ratio because you have a much smaller equity number you're dividing debt by. So, you know, that can impact that. And of course we see that kind of happening a little bit here. Lowe's debt-to-equity ratio is sitting pretty heavy at 2.23. I mean, that's, you know, I think you know, the line in the sand for a lot of businesses, when you start to look at, you know, kind of thinking about the balance sheet in terms of being excellent and in terms of being, well, there's a little bit of leverage there, that debt-to-equity ratio number you're usually looking at is 1. When you start to see a number of, when you start to see a 1.0 debt-to-equity ratio or anything higher than 1, you start to think in the back of your mind is like, oh, you know, there's a little bit of leverage there. You know, you start to become a little uncomfortable with the amount of leverage. When you start getting into the 2s and the 3s and the 4s, you start to feel real uncomfortable with the amount of leverage. But again, that number can be massaged a lot. And I don't really use that metric too much. I include it in the articles because it is so popular. It is bellwether metric for the balance sheet, but you know, I don't place a lot of importance on it, especially with companies that buy back a lot of stock, as Lowe's does, as we just saw. That said, it does look pretty heavy, but the number I place a lot more importance on is the interest coverage ratio, because that actually tells me what percentage of the company's EBIT is having to cover its interest expenses. So it would be somewhat analogous, not totally, because I mean you can't compare a business to an individual, but somewhat analogous to, you know, what percentage of your income is covering all of your debt, your interest expenses. You know, if you have your mortgage and you have your credit cards and you have your car payment or whatever, and you look at all of the interest expenses from that debt lined up, and you say, well, what percentage of my income, you know, what percentage of my income is covered that, or you know, how much as a percentage, how much is this interest expense eating up, you know, my income? When you start to look at that number, that's really what you want to look at, because if you're just looking at, well, this is the debt compared to my assets, but the assets are maybe inflated by this or deflated by that or whatever, or my housing value is impacted by what Zillow's saying, you know, your debt to equity ratio can be kind of impacted by a lot of stuff that may not be totally relevant to everyday numbers. And really what you want to find out is, you know, how many times over Lowe's can cover its interest expenses via its income, which you're looking at EBIT, which is earnings before interest and taxes, okay? So when we get that number, we look at pre-tax earnings right here, 5.2 billion. And in order to get EBIT, because the pre-tax earnings is you're not getting the I in the EBIT, right? You're just getting the EBT. So we need the interest expense back in there. So we need to add that 645 million back in, which you see right here, right, guys? Interest net, you see 645 million. So you got EBIT of 5.8 billion. Pre-tax earnings along with the interest expense, EBIT, you got 5.8 billion. And then you basically just divide that by the 645 million. So you know how many times over that EBIT is covering the interest expense. And you get a little over 9, which is a pretty solid number. I don't have any problems with that number at all. No trouble with that number. Usually when you see a debt to equity ratio as high as it is right now, and again, kind of going back, I'll show you where I got that debt to equity ratio. You see long-term debt, 14.3 billion, which, you know, relating to the company, we're talking a market cap of 64 billion. So you can already tell right away, well, they got 14 billion, the market cap is 65 billion. It's really a small percentage of the company. That right away kind of says, well, I don't really think I'm real concerned about that. But nonetheless, and we see shareholder equity down here, 34,408, right? Divided by 34,408, 34 billion. Whoop, I didn't do that right. Sorry, guys. 14,394 divided by 34,408. Whoop. I'm sorry, I'm looking at the wrong number here, guys. That's what I was like, what am I doing wrong here? Sorry, I'm looking at total liability shareholder. I'm looking at the wrong number. Shareholder equity right here is 6434, 6.4 billion, which is about 10% of the market cap of the company, which again, you know, when you look at that, you say, why is the equity so low? That's just crazy, and that's what's impacting that long-term debt to equity ratio. So again, 14,394 divided by 6434. We got a long-term debt to equity ratio of 2.23, which I should have reflected in the article, 2.23. So yeah, that number does seem pretty top heavy there when you look at it, but then when you see the interest coverage ratio above 9, I'm not real concerned about the debt to equity ratio at all, and that's really because the equity number is so low, which again was kind of throwing me off a little bit there for a second, because I'm just I wasn't looking at the right number. I was just looking at this bottom number here, but the shareholder equity is basically 6.4 billion. Super low. And let's just see for comparison, because I don't know if I looked at it where it was a decade ago. Yeah, so you see shareholder equity here 10 years ago, guys, at 16 billion, right? So the company certainly isn't a smaller company than it was 10 years ago. It's not worth less than it was 10 years ago, but shareholder equity is a fraction of what it was 10 years ago, and that's usually because, you know, they retain some of that stock. They have treasury stock and things like that, and that can definitely impact the equity. And there's a lot of other things that can impact equity, which is beyond the scope of the article or beyond the scope of the video today. But nonetheless, you know, you see that the equity is basically a fraction of what it was 10 years ago. You see it's a fraction of the market cap of the company. It's just not a real good number to really place any kind of bet on or any kind of importance on. I really don't even look at that other than when I write these articles, and I kind of say, well, for anybody interested, for any parties interested, the long-term debt to equity ratio is pretty strong at 2.23. That's high, but it's not really something I'd be worried about. Getting into profit margin, when I look up the 5-year average for this, when I look at the profitability of a company, I'm looking at net margin and return on equity. Again, I'm looking at two numbers. I'm looking at net margin, return on equity, and just like with the balance sheet, one of these numbers is a lot more important to me personally than the other. And again, relating back to the initial point, this number here, ROE, return on equity, this 5-year average at 20.41%. Again, I don't place a lot of importance on that number at all, because equity, not only can equity be juiced by a lot of debt, it can also be negatively affected, as we just saw, by a lot of things like share buybacks and things like that that can draw that shareholder equity number down into actually with a lot of companies. I see a lot of companies out there with negative shareholder equity. Of course, you know, the company could be worth billions and billions or even hundreds of billions of dollars, but you'll see a negative shareholder equity, which affects, of course, ROE, makes it, you know, basically not applicable, and it affects long-term debt to equity ratio, which is also not applicable. But you know, this 20.41% number, it's a solid number. It's a solid number for a retailer and things like that. But you know, if we had a more accurate shareholder equity number, you know, that would impact that number. Again, if Lowe's decided to take on more debt, you know, because they wanted to build out more stores and sell more stuff, but maybe at an incrementally lower profit margin, you know, that might juice ROE at the expense of profit margin. So I don't really look at ROE too much. The number I'm really looking at is net margin, because that tells me bottom line out the door. There's a couple different margin numbers you can look at. You can look at gross margin, operating margin. I look at net margin because it's basically bottom line. You're looking at, you know, what percentage, you know, you're looking at net income against revenue. And in order to get that number, we'll go back to the most recent annual report. If you want to look at where it's at for this most recent fiscal year, you're basically just taking net income dividing by revenue. So 3093 net earnings, net income, divided by total revenue, total sales. So you've got a net margin of about 4.8%, 475. What does Morningstar have it at? They have a 471, so it's pretty close. Again, they're usually pretty accurate with these numbers. It's right in that same range. So you've got a pretty solid net margin. I mean, and you can see a pretty solid number here. You see here, as we go through the 10 years, the net margin is pretty much unchanged. It's been pretty much the same number across the board. Of course, you can see major spikes and drops depending on if there was some change in net income, if there was some adjustment or something they took to the GAAP numbers. But for Lowe's, it's been pretty solid throughout the course of the last 10 years, which again relates back to that initial point where I talked about how you can see excess bottom line growth relative to the top line. You often see that due to you know, an expansion in the net margin, in the margins of the company, and or you see extensive share buybacks. Well, for Lowe's, again, it was pretty much just the share buybacks, which are pretty substantial, because the margin is pretty much unchanged. But I like net margin again because, as I just showed you, you're basically saying, okay, you sold $65 billion worth of goods, but what's the profit? You know, after everything's all said and done, after taxes are paid, and after the cost of goods are subtracted out, after it's all said and done, bottom line number, what percentage of that revenue is converted into profit? And that's net margin, and that's why I like that number. That tells me basically bottom line where we're at with everything, and that's a pretty solid number. I mean, a lot of retailers, a lot of legacy retailers have a really hard time getting into that 2, 3, 4% range. You know, I see some retailers out there with net margin of 1%, 1.5%. So, you know, Lowe's isn't doing too bad here. And in order to get that 5-year average, as you guys can see right there, as I included in the article, I use the CFRA number here, which they use the 5-year average right here. You see 5-year ROE at 20.41%, and you see net margin at 4.18%. So you see 4.18% and 20.41%, and those are accurate based on what they have here. So what CFRA does, basically, they look at the numbers. They looked at net margin over the last 5 years. They look at return on equity over the last 5 years, and they did each year individually, and then they just average it out. And I like to use a 5-year average because any 1 year, as I spoke about just a moment ago, can be impacted by all kinds of things that can, you know, if they're taking some kind of hit to GAAP, you know, earnings or something like that, and you know that can affect net income. You know, if they take, you know, they get some kind of massive gain 1 year or something like that, and that positively impacts GAAP numbers, that can show you a huge net margin or something like that that might not be really accurate at the end of the day. So I like to use the 5-year average, which gives me a pretty recent average in terms of what the business is doing. And these are solid numbers. Against retailers as a whole, their most direct competitor, of course, is Home Depot. You see some better numbers there on their profitability. Again, ROE, you see here, right, what I was just talking about with ROE not really being all that valuable. Home Depot's return on equity is 150%, which is humongous. You know, it's like, what? But then you see their long-term debt to equity ratio right here is over 5. You know, that's, you know, Home Depot just has a ton of debt, so of course the return on equity is also juiced. I mean, that's the thing. You can juice ROE through taking on a bunch of debt, but that doesn't make it a better number. It doesn't make you a better business. I look at profit margin, and of course Home Depot's more than holding their own here too. So, you know, you could argue that a lot of different ways. You know, you're saying, well, they're taking a lot of debt to juice ROE, but hey, they're also killing it on the margins. So what that really tells me is that although Lowe's is doing pretty good in terms of profitability as a retailer within the universe of retailing in general, I think there's definitely some room for improvement here, especially on the margins, because, you know, if their nearest competitor is dominating them when it comes to margins, then Lowe's has some real room for improvement there. Now, I'd like to see that number go up a little bit. It's been pretty steady. There doesn't appear to be any I mean, you can maybe see it. You see a dip here. You see it kind of steadily rising through the last few years. So, you know, there might be some evidence of some expansion, but I don't really see it. There's nothing real compelling there for me to indicate that. But I would like to see that higher. You know, I'd like to see Lowe's. I'd like to see the net margin, you know, maybe 5, 6, 7% or something like that, which would be even better. But as it sits, not a bad number. And then we get into the valuation. So I think the stock does look undervalued, and I present that idea from a couple different angles. I mean, the PE ratio 23.2, that doesn't look, well, when I wrote the article, it's 23.2. Where's it at right now? It's 22.03. So yeah, so the earnings weren't reflected in the numbers quite yet when I was putting these numbers together. Again, I write an article, and then the article is published sometimes up to maybe a week after I'm compiling the numbers, and then this video might come out even a few weeks after that. So a lot of times when I'm doing these videos, as I've talked about in prior videos, you'll sometimes see some lag. You know, I may be looking at numbers from the prior quarter or something like that. So when I'm looking at trailing 12 months numbers, which would include like the payout ratio, which includes, of course, the PE ratio, because you're looking at the last 4 quarters of earnings, and then you're taking the price and dividing that by the last 4 quarters. There's sometimes some fluctuation there, so it's still pretty much the same as what it was before. But I don't think that in and of itself, that PE ratio sitting up in the low 20s, it doesn't necessarily in and of itself indicate undervaluation, because first of all, it's not too far away from where the broader market's at, but in addition to that, it's also not too far away from where the 5-year average is at for Lowe's. Their 5-year average PE ratio is kind of right in that range. So that in and of itself doesn't, you know, it's not saying, wow, there's a massive discount here, but where I think part of the idea for Lowe's coming in at undervalued is, first of all, if they are going to accelerate off of that base, which that using that 10-year, looking back at the last 10 years in terms of their growth, is looking at a very challenging period. Knowing what we know about the housing market here in the United States, knowing what we know about some of the opportunities, knowing what we know about the share buybacks and things like that, there's certainly some evidence of acceleration there. And looking at that, if they start to grow up in that low double-digit range, then certainly a PE ratio, especially in this market where growth is hard to come by, that doesn't look all that bad at all. And especially knowing that the 5-year average, of course, when they were still kind of going through some of those challenges, is even a little bit higher than where it is now, where maybe Lowe's is even sitting prettier than where they were before. That lends itself to maybe saying, we might have an opportunity here on our hands. So I note that I say that while the PE ratio of 23.2 is pretty much right in line with the stock's 5-year average, the company's cash flow is available at a discount to its 3-year average. So let's take a look at that. So yeah, you see here the cash flow, 11.1 times. So investors are paying about 11 times the company's annual cash flow. They were paying 13 times over the last 5 years. I'm sorry, over the last 3 years on average. So there definitely is a discount there. You see the broader market here. You see a discount to that. You see a discount to the 5-year average, or the 3-year average, excuse me, for the cash flow. But most notably, as I noted in the article, the yield is definitely well in excess of what it's averaged over the last 5 years. So the recent historical average for the stock's yield is 1.5%. It's now sitting well over 2. So that right there is one of the bigger keys for me saying, we might have a pretty solid stock here on our hands in terms of undervaluation. So I note that, hey, it might not be a screaming bargain where you have 40% undervaluation. I mean, I'm not saying that Lowe's is massively undervalued where it's just this humongous opportunity and the stock looks incredibly cheap. I'm not saying that. I'm just saying that I think there is an opportunity here to buy into a high quality stock, a high quality dividend growth stock with more than 50 consecutive years of dividend growth, a very strong dividend growth story, and it doesn't look to be expensive. If anything, it looks to be a little cheap right now. I mean, I'm not saying, massively cheap, but I am saying, there's an opportunity here where you've got a really great stock at a discount. Even if the discount is maybe a little slighter than I'd like to see, I think there's a discount here. So when I do the dividend discount model analysis, of course, I say, well, if it is undervalued, where are we at? What's an estimate of its intrinsic value? I did the long-term dividend discount model analysis, of course, as usual. So we got to know the dividend. So we've got the quarterly dividend of 41 cents. So the annual dividend is $1.64. And I use the Money Chimp. Again, I have a spreadsheet that I use, but this is a good substitute. It comes up with the same numbers I come up with, and you're basically just you're looking at the annual dividend, you're looking at growth, and you're looking at your discount rate, as I talked about in prior videos. So the growth rate I used for Lowe's is 8%, as I noted here, and I admit that is on the high end of what I normally allow for. 8% is pretty much my cap. That's as high as I go when I use my dividend discount model analysis. I don't go any higher than 8%. But I note that Lowe's has a great track record for delivering huge dividend increases. They've got one of the longest historical track records out there for dividend growth. And when you look at the historical earnings growth, the long-term dividend growth, and the forecast for future growth and the payout ratio, I don't think this is unreasonable. As I spoke about earlier, I said that over the near term and even over probably the long term, to expect 8 to 10% earnings per share growth, compound annual growth for Lowe's, I don't think that's unreasonable. We've got a 7% plus, almost 8% growth rate over the last 10 years, which is extremely challenging. You've got maybe some supply issues here in the United States. You've got a pretty strong economy. Can they accelerate off that? CFRA thinks they'll double. I'm actually backing the dial up and saying, I think 8 to 10 would be probably a more reasonable expectation. But if they come anywhere near 14%, then you can expect like dividend growth because of where their payout ratio is. Lowe's is obviously willing to expand that payout ratio. So it wouldn't be crazy to expect them to maybe expand it a little bit more from where it's at. I'd like to see them probably keep it in that 50% range, but it would not be unreasonable for them to expect them to say, well, we're going to move it up even a little bit more. So you can expect like dividend growth, if not a little higher. So if they do come in at my expectation 8 to 10, then 10% dividend growth for the foreseeable future seems very likely. If they grow anywhere near what CFRA thinks they'll grow at, then it's not crazy to think that the dividend is going to grow at 13, 14, 15% for the foreseeable future. I came in at 8. Again, I think that's although it is on the high end of what I would normally allow for, I don't think I'm being irrational here with that. So of course the discount, the discount rate is 10%. This is a stock with a 2.2% yield. What is it right now? 2.1% yield, so I'm not going to use a lower discount rate than that. That's you know, I'm looking at 10% on something like that. So it gives me a fair value of 88.56, as I note right here. I talk a little bit about the dividend discount model analysis and why I use it. And of course, as I note in this paragraph, I said it's not a screaming bargain, but the stock shouldn't be. I don't think that you need to approach every stock you invest in or every business you invest in with the mindset of I need to get this at a rock bottom price, rock bottom valuation. You know, I don't think, you know, certain high quality businesses deserve maybe a premium to the broader market, and Lowe's isn't. You know, Lowe's is arguably a company that's higher quality than the average in the broader market, yet it's priced at a valuation that's slightly below where that average company might be. You know, certainly relative to its 5-year average, certainly relative to where the yield's been over the last 5 years, and certainly to where the cash flow's been over the last 3 years. So you're getting a well above average company at a slightly below average valuation, and there's a gap there. So you've got, you know, if you got average here, you got quality over here, and you got valuation maybe somewhere in that range. So there's a gap there. And again, I don't think it's significant where we need to be shouting from the rooftops that Lowe's is this massive bargain, but you know, I think there's an opportunity there, a long-term opportunity. And of course, I always compare my valuation to what, you know, a couple different professional stock analysis firms come up with. The first one's Morningstar, of course, and they've got their fair value at $93, so a little higher than me. So you know, again, I used an 8% growth rate, which is on the high end, but I don't think I was being irrational there, and I came out lower than Morningstar. So Morningstar was actually being a little more aggressive than I was. And when I write a lot of these articles, I find that I'm usually kind of somewhere in the middle. If actually more often than not, I'm probably on the low end. This one I came out in the middle, so they have it at 93, but then CFRA has their fair value at 83.50, which let's see if now they changed it to 83.30. Yeah, like I've said before, I think in every video I've talked about this, how CFRA, they seem to like change these numbers. It's all the time. It seems like every time I load it, there's a slightly different number down here, but it's 20 cents different. I don't even know why you'd bother to go in and change your fair value by 20 cents. I don't even know what the point of that would be, but it doesn't really change the bottom line, doesn't change the conclusion at all. So again, I came out in the middle. You know, I'm coming in at 88. They're coming in at 93. They're coming in at 83. And I like to average these three numbers out. And when I average them out, I come out to 88.35, which is right about where I came at. Right, guys? I came in at 88.56. The averaged valuation for the three numbers is 88.35, so just a few pennies away from what I came up with. And at the time I wrote this article, that indicated that the stock was 19% undervalued. So I think it's increased a little bit. Let's take a look at where it might be at now. So we came out with 88.35. It's now at 78.11. So we're closer to 13%. So yeah, the stock has definitely popped a little bit since I came out with this article and said it was undervalued. Yeah, you can see the price here, the price tag right here, 73.86. So we've got that tag down there. So yeah, the stock has moved up by about $5 a share, which, or closer maybe to $4 a share. So it's had a little bit of a move up. You know, I probably should have bought the stock when I wrote the article, to be honest with you. I was really looking at it, and I'm just like, you know, I don't know. I've got, I was looking at some other things with maybe some higher yield at the time, but I think it's even now at 13% undervalued. Again, I think you're getting an above average quality business at a, you know, slightly below average valuation. I really think that's where you're looking at with Lowe's, and I talk a little bit about that here. You know, you've got one of the highest and largest one of the highest quality and largest retailers out there, numerous unique competitive advantages that should stave off some of the threats that most legacy retailers are facing. As I spoke about earlier, I think that Lowe's is pretty insulated from some of the headwinds that a lot of legacy retailers face. You know, you compare Lowe's to like a company like Macy's. Macy's doesn't really offer anything unique. It's just a department store that calls merchandise from all these other different brands and just presents it out there. Then, you know, you go in and you shop for clothes and things like that. But that isn't really a thing unique. Lowe's does provide something unique. They provide merchandise that you're probably going to need more immediately. They provide professional advice, professional installation. They have the contractors. They have the professional angle for professionals that come in and require their goods. You have a lot of products that aren't necessarily very easy or very cheap to ship. You know, you can't. It's very difficult to just go buy a new refrigerator online and ship it. I mean, you know, some of the stuff isn't super easy. You need a washing machine. You're probably going to need something like that installed, depending on your, you know, personal capabilities and stuff. So I think there are some competitive advantages there in place for Lowe's. And speaking of which, Morningstar rates their they always rate the moat, an economic moat for a company, which, if you think of a business like a castle, you want a big moat around that castle to keep it protected from the hoarding invaders that are other businesses. And they rate their economic moat as wide, which is good. Obviously, a wide economic moat would indicate that the company has strong, durable competitive advantages. If you have a narrow moat or no moat at all, then you're more prone to changes in the business model, and you're more prone to competitors taking you over at some point and kind of wiping you out. But I think with undervaluation, 55 consecutive years of dividend increases, this is a great opportunity right here, guys. Sorry about that, guys. Had some more barking dogs there. But anyway, so I think in conclusion, it's a great company. It's a great retailer, number of competitive advantages, wide economic moat. You've got, again, not massive undervaluation, but certainly enough to warrant this stock is a compelling long-term investment idea right now, and certainly something I feel comfortable presenting to the investment community at large. Hope you enjoyed the video. It was a pleasure for me to do the video, to write the article. It's again, I'm humbled at the opportunity to write these articles for almost 3 years now. It's an incredible opportunity for me. I love it. I hope to continue doing it for a very long time. I hope you guys enjoyed the video. I hope you enjoyed the article. If you have any feedback, certainly present that to us. If you love the videos, or if there's something you want to see different, if you want to send something over to Daily Trade Alert or myself letting us know about that, happy to make any changes that you guys might want to see. In the meantime, I hope you have a wonderful day, and I wish you the best of luck with your investing endeavors and your life endeavors. Appreciate it very much. Have a great day, guys. Thanks so much. Bye-bye.